All right, let's talk about what just happened in the precious metals market on January 30th. It was a sudden, absolutely brutal crash that left a lot of investors reeling. It was, one of those days that started with coffee and ended with a whole lot of questions.
So let's just start with the damage report, because this one number, it says everything. In just one single day, silver didn't just fall, no, it absolutely plunged off a cliff. A double-digit drop like that in 24 hours is, wow, it's incredibly rare, and it caught pretty much everyone completely off guard.
And that was the feeling everywhere. The sentiment just flipped. From total euphoria to sheer panic, basically overnight. Analysts weren't mincing words. They called it a complete bloodbath, and honestly, that might have been an understatement.
So yeah, this was the great metals crash, and it was just pure whiplash. Because just a few days before this, markets were hitting all-time highs. And the speed of this turnaround is really what shocked everybody.
Yeah, think about that. Just 48 hours earlier, we're all celebrating these explosive rallies, record highs in January. And then, bam! A whole month of just incredible gains, gone. Wiped out in one single brutal day. It was the definition of the market turning on a dime.
So you gotta ask, right? What on earth just happened? And the big one, is the party over? Is the bull market done? Or was this just a really nasty speed bump on the road?
Okay, to really get this, we've got to separate two things, the trigger and the fuel. Think of it like a fire. There was a spark, for sure, but there was a whole lot of dry tinder just sitting there waiting for something to happen.
And it all kicked off with a single announcement from Washington, D.C. The news that Kevin Warsh would be the new Federal Reserve Chair, well, that set off this chain reaction. It was predictable maybe, but man, was it violent.
See, the market really liked the Warsh pick. They saw him as a steady hand, a stabilizing choice for the Fed. So what happened? People bought dollars. The dollar spikes, and that's almost always bad news for metals. It's that classic inverse relationship, A stronger dollar means it costs more for everyone else around the world to buy gold, so the price naturally tends to fall.
But, and this is where it gets super interesting, the reaction was completely out of whack with the news. Look at this. The dollar strengthens by what? 0.25%? And silver crashes over 10%? No way! That doesn't add up. So what was really going on?
Right. So the dollar was the trigger, but it absolutely was not the fuel for this fire. A tiny move like that doesn't cause a total meltdown. The real reason was all the euphoria, all the massive profits just sitting there, ready to be taken. The dollar news was just the excuse everyone was waiting for.
And to understand that fuel, you just have to look at how insane the run-up was. In 2025, some silver funds were up 200%. 200. Then, in January alone, they tacked on another 52%. That's what we call a parabolic move. It's just going straight up. It can't last. And you better believe investors were sitting on these massive, massive gains, just getting antsy.
This quote just nails the psychology perfectly. It's like everyone was packed into a crowded theater, and their pockets were stuffed with cash. The Kevin Warsh news, that was just someone shouting fire. It wasn't the fire itself, but it was the reason everyone sprinted for the exit all at once.
And of course, this whole thing really highlighted silver's reputation, right? It's kind of the drama queen of the metals world. Gold took a big hit, down about 5%. But silver? Oh, it plunged more than twice that. So, why is it always so dramatic?
Well, the answer really comes down to something called the gold-to-silver ratio. It's a super important metric, and it tells you exactly how stretched, how out of balance the market had gotten. It's a pretty simple measure of their relative value, but it tells a fascinating story.
Okay, so look at this. Back in early 2025, that ratio was way up at 90. That meant silver was dirt cheap compared to gold, and that's what kicked off this huge rally. But January of 26, that ratio had squeezed all the way down to 57, which is much closer to its historical norm. So you could think of it like a rubber band that got stretched, and then it just snapped back hard. Silver had run so far, so fast, that it just had way farther to fall.
Okay, so that's the anatomy of the crash, but now we get to the really important question. Does one terrible day actually change the long-term story for metals? Well, if you zoom out, really zoom out past the daily panic, the picture looks completely different.
Let's start with silver. The experts are saying no way, the bull market is not over, and here's why. There is a massive real-world supply crisis. For 5 years running, we've used more silver than we've been able to pull out of the ground.
A panic in the paper market doesn't change that fundamental fact. The guys making solar panels, the tech companies, they still need to get their hands on actual physical silver.
Now, gold's long-term story is just as strong, but it's a different story. It's not about industrial demand from solar panels or 5G. It's about a different kind of buyer altogether, a much, much more powerful one.
And this is really the story that's hiding just beneath all the daily headlines. It's a massive shift in global finance, and it's been developing for years. It really puts a one-day crash into a much bigger perspective.
I mean, just look at this. For the first time in 30 years, foreign central banks, we're talking the biggest players in the world, now hold more of their reserves in physical gold than they do in US government debt. That is a huge deal. Just let that sink in for a second.
And this isn't some short-term trade. This is a massive, structural shift. It's a very clear, very deliberate move away from the US dollar and towards sovereign, hard assets, assets that you own, that can't be frozen or controlled by another nation. See, central banks aren't panic selling because of some Fed news. They're doing the opposite. They're accumulating.
Okay, so what happens next? If the long-term fundamental story is still solid, how are you supposed to think about this kind of stomach-churning volatility? What's the game plan from here?
Well, the expert consensus seems pretty clear. First, don't chase these insane vertical moves. That's just FOMO. And second, don't panic sell when you get these sharp drops. The idea is to use these dips as opportunities, to use a staggered, systematic approach to buy the dip. And yeah, despite the crash, you're still seeing some pretty aggressive price targets out there for the rest of the year.
And that really leaves us with this one last question to think about. While the daily market is going crazy over paper prices and Fed appointments, the world's central banks, they're telling a completely different story, a much longer-term one. And it forces all of us to ask a really crucial question. In today's world, what is the true safe haven? Is it paper or is it metal?